Right now, as we speak, Datavault AI Inc., ticker symbol DVLT, is trading at exactly 1.54 USD. The stock is down by approximately 0.021 points, representing a decline of 1.38% on the intraday chart. If you are watching the order book, you are seeing a battleground where bears are attempting to push this below the psychological 1.50 support level, while bulls are trying to defend the line based on recent revenue guidance upgrades. It is a tense moment for anyone holding shares, and if you are just watching from the sidelines, the volatility we are seeing today is the kind of movement that either makes you incredibly nervous or incredibly interested. Most people looking at this chart see a penny stock struggling to find its footing after a massive surge. They see the volatility and assume this is just another pump and dump in the artificial intelligence sector, a company riding the coattails of giants like Nvidia stock without any substance to back it up. That is the expectation. You look at a chart like this, you see the low price, and you think risk, you think gamble. But the reality is significantly more complex and frankly far more interesting than a simple chart reading would suggest. While the market is pricing this like a distressed asset today, the actual developments under the hood suggest that Datavault is aggressively repositioning itself from a legacy audio technology company into a data monetization infrastructure play. The disconnect between the current price action, which is driven by short-term sentiment and perhaps some profit-taking, and the long-term guidance the company has just issued is creating a curiosity loop that we need to examine closely. We are not just looking at a stock that is down 1 or 2%. We are looking at a company that has recently raised its fiscal year 2026 revenue guidance to over $200 million, yet it is trading at a market capitalization that barely reflects a fraction of that potential if they execute. This is the tension. The market expects failure or dilution. The company is signaling massive growth. One of them is wrong, and identifying which one is wrong is where the opportunity usually hides. Let's talk about what is happening on the screen right now. The trading volume today is substantial. We are seeing millions of shares change hands, which tells us that this is not a dead stock. It is a highly active battlefield. When you see this level of liquidity in a stock trading under $2, it usually means that retail investors and high-frequency algorithms are fighting for control. If you are using platforms like Robinhood Stock Trading or the Robinhood app, you are likely seeing this ticker pop up on the daily movers or most active lists. This visibility is a double-edged sword. On one hand, it brings in a flood of capital from traders who are just looking for a quick scalp. On the other hand, it attracts short sellers who know that retail traders often panic when the chart turns red. The movement we are seeing at 1.54 USD is a test of conviction. Are the people buying today planning to hold for the $200 million revenue target, or are they just hoping for a bounce to 1.60 so they can sell? The price action we are witnessing today also correlates with a broader cooling off in the speculative AI sector. While Nvidia stock continues to be the bellwether that holds the entire industry up, capital has been rotating out of the riskier, smaller cap names and back into the safety of the Magnificent Seven. This macro rotation puts pressure on stocks like DVLT. When the big institutional players rebalance their portfolios, they often trim the edges, and for many, a small-cap AI company is the first thing to go. However, this creates a potential entry point for the individual investor who is willing to do the homework that the algorithms simply do not do. The algorithm sees small-cap, negative earnings, high volatility, and they sell. A smart human investor might look at strategic partnership with Silex, 148% year-over-year revenue growth, and see a mispricing. If you are managing your own portfolio, perhaps through a self-investing setup like Schwab Intelligent Portfolios or a standard individual brokerage account, you have likely noticed that the market has become incredibly punishing of any company that misses a beat. But Datavault did not miss a beat in their recent news. They actually exceeded expectations. The stock is down today not because of bad news, but likely due to technical factors and perhaps some insider selling that spooked the herd. We saw reports of a director selling shares recently, and in the microcap space, insider sales are often misinterpreted as a lack of confidence. But executives sell for many reasons: tax planning, liquidity, personal expenses. It doesn't always mean they believe the ship is sinking. But the market shoots first and asks questions later. Let's shift gears to the company itself, because understanding what Datavault AI actually does is critical to understanding why this 1.54 price level matters. The expectation is that this is just another AI wrapper company, a business that takes ChatGPT, puts a logo on it, and sells it to gullible investors. If that were the case, I would tell you to run for the hills. But the reality is that Datavault is built on a massive portfolio of intellectual property, specifically in the acoustic and data science fields. They are pivoting to monetize data assets. We are moving into a time where data is the new oil. A cliché, yes, but accurate. Companies need to verify, track, and monetize their data streams. Datavault's Verify You system and their focus on real-world asset tokenization places them right in the middle of the Web3 and AI intersection. This is not just asking a chatbot a question, this is about building the plumbing for the future data economy. Consider the recent partnership with Silex Holding. This is a deal designed to monetize genomic and therapeutic data. This is high-value data. We are not talking about monetizing cat videos here. We are talking about medical data, which commands a premium. The market seems to be ignoring the implications of this. If Datavault can successfully license its technology to pharmaceutical companies and defense contractors, which they've alluded to in their PR, the revenue quality they generate will be far superior to a typical ad-based tech company. The market sees a penny stock. The reality is a company signing contracts with Tier 1 defense OEMs and global pharmaceutical players. That is a massive disconnect. When you look at the broader landscape of online investing, it's easy to get lost in the noise. You open your Fidelity mobile app or your Interactive Brokers trading platform, and you're bombarded with tickers. Why pay attention to DVLT? Because of the asymmetry. If you buy Apple stock or Tesla stock today, you're buying a known quantity. The upside is likely capped because the whole world already knows the story. With Datavault, you're buying a show-me story. The market is saying, I don't believe you can hit $200 million in revenue. If they do, the repricing of this stock would be violent and rapid. If they don't, the downside is obviously pain. But that is the game. Let's discuss the technicals on the chart in more detail. At 1.54, we're hovering near a support zone that was established during the last consolidation phase. If you look at the volume profile on your trading screen, perhaps using the advanced charts on thinkorswim, or even the basic view on SoFi Invest, you will see a volume shelf right around this 1.5 to 1.60 area. This means a lot of shares have exchanged hands here past. It creates a memory in the market. Traders who bought here previously and made a profit will likely defend this level. Conversely, if it breaks decisively below 1.50, we could see a flush as stop losses get triggered. This is why the intraday action right now is so critical. The bears are trying to trigger those stops. The bulls are trying to absorb the selling pressure. It is also worth noting the retail sentiment. I want you to take a second and comment below how many shares of Datavault AI you currently hold and what your average price is. Are you underwater right now, or did you get in early? Seeing where other investors are positioned can give us a great sentiment indicator that you won't find on a Bloomberg terminal. Speaking of sentiment, the chatter on forums and social media regarding DVLT is a mix of extreme optimism and extreme skepticism. This polarization is actually good. You never want to be in a stock where everyone agrees. If everyone loves it, who is left to buy? If everyone hates it, who is left to sell? The fact that there is a heated debate about whether this is the next big AI play or a zero suggests that the price discovery is still happening. For those of you using investing sites to track social sentiment, you will likely see DVLT trending. Now, let's analyze the risks, because we need to be responsible here. The biggest risk for a company like this is cash burn. Expanding into new verticals, acquiring companies, and developing AI tech requires capital. If they cannot generate enough free cash flow from these new deals, they might have to raise funds. In the stock market, raising funds usually means issuing new shares, which dilutes existing shareholders. This is the shadow hanging over the stock. The fear of a secondary offering is often what keeps a stock price depressed even when good news comes out. Investors are waiting for the other shoe to drop. They're asking, "Great revenue guidance, but how are you going to fund the operations to get there?" Until management answers that question definitively, the stock might remain range-bound or under pressure. However, there is a counter-narrative to the dilution fear. If their stock price appreciates enough, they can use the stock as currency to acquire revenue-generating assets, which is non-dilutive in terms of value if the acquisition is accretive.